What's up guys, it is Sam here, and today I'm going to be talking about the thing that's going on in the markets at the moment, destabilizing them, sending them up and down just so dramatically. It's happening in both the States and in Europe, and it's really affecting us. So what I'm going to be talking about, of course, is the bank collapse that has happened with SVIB, but also just to kind of more generalize it, like what happens when a bank collapses and how does this start to affect people. So I'm going to focus in on SVIB because it's kind of clear what's happened there. They didn't have liquid money and everyone tried to withdraw at once. But I'm just going to go through what actually happens, how it affects individuals, how it affects corporations, and what central banks are actually trying to do to counter this mass liquidations that could possibly have a knock-on effect to other banks as well. So there's quite a lot to cover, but it's going to be pretty interesting just to kind of go through all the different topics and how a bank collapse affects everyone else around them. So guys, without further ado, let's get straight into the video. So guys, what happens when a bank collapses? It means that the bank is unable to meet its financial obligations, including paying back its depositors, its creditors, and the collapse of the bank can have serious ramifications across both consumers and corporations. So if you look at this big bank collapse that have happened in history, you may look at the 2008 crisis, which produced two of the biggest bank collapses ever. So number one, you have the Lehman Brothers, which 691 billion in assets under management, that collapsed. You have Washington Mutual, which 2008 of 307 billion in assets. WorldCom in 2002, they had 103 billion in assets, and India Mac Bank in 2008 also had 32 billion in assets. Continental Illinois National Bank Trust had 40 billion in assets in 1984. And the Silicon Valley Bank that collapsed just only around a week ago, or 10 days ago, depending when this video was released, was around 210 billion. So it firmly slots into the third biggest bank collapse of all time. So this is going to have ramifications across everyone that was involved in this bank, whether you're a creditor, a depositor, or a lender, or you're just an investor in the bank. So as some of the conditions and the issues that arise for consumers, they have a loss of deposits. So consumers who have deposits in the bank may lose some or all of their money if the bank is unable to pay them back. If it's because most banks, say in the US, in Silicon Valley's case, are only insured up to $250,000 per bank account. So that's how much they are legally can get back through the FDC insurance that they have over there. So they have massive disruption in their banking services. So consumers may experience disruptions in their banking services, such as ATM withdrawals, online banking, and writing checks, as the bank tries to solve these issues. But if it's gone insolvent, you may have a lot of trouble to do this. So you'll also have issues if you're trying to obtain credit from this bank still. You may find it very difficult if you're trying to get a loan from a bank that is going insolvent. It's going to be basically non-existent. You won't be able to do this. It also brings reduced confidence in the banking system. So consumers will lose confidence in the banking system and may withdraw their deposits from other banks as well, leading to a run to the banks, which will give you a liquidity crisis. A liquidity crisis is just when everyone's all their money at once, so the bank is supposed to have all of the cash on hand to give to you at that time. So this is something similar to what we saw with FTX in the crypto world, and they didn't have all their money at once, and then they collapsed because they have to start selling assets to then pay people out. So it's the same kind of principle. So then you're also going to lose possible job losses as well. So the bank collapse can also lead to job loss in the bank industry and also in the Pacific Bank itself. Obviously, if it's going insolvent, a lot of these jobs are going to be at risk. So look, there's a good few things to cover there, and consumers are quite affected if a bank does collapse. So what the effects are when it goes to a corporation, they do slightly differ. So corporations, they have a loss of their assets. If they invested into a failed bank, they may lose all of it or some of their assets because the bank is going to be unable to pay them back. Same as we've discussed for consumers. So they also going to have massive disruption in their banking services. They may not be able to do like accounts payable, pay for stuff, invoicing, all that kind of stuff is going to be affected that way. They're also going to have a difficulty obtaining credit, so loans, same sort of thing. Because a lot of companies are obviously financed by loans, and especially in the Silicon Valley case, they funded a lot of different startups. So the lot of different startups are all funded by the Silicon Valley. They're going to now obviously have their assets sold, or different banks are going to buy the loans, hopefully for most of these companies. So they're going to buy the loans, but for the moment it's going to be pretty difficult for them to obtain more credit. So they also have reduced confidence in the economy. So if a bank collapses, it doesn't really signal very well for the economy. And at the moment, there is a lot of different issues facing the economy with like inflation, increasing interest rates, which is half being blamed for this. So they increased interest rates too quickly. That has now led to this kind of banking collapse, which is interesting to see. So it's going to have a reduced confidence for companies to want to spend more money, want to borrow more money, and to invest in businesses. And it's also going to affect then consumer spending as well for corporations. So if your consumer stops spending, they're not going to be making as much money. So also you're going to then run into like possible bankruptcies, as a bank collapse. They can have you can have possible bankruptcies if they're heavily exposed to debt to this company, and it's a possibility in rare and extreme cases that a company could go bankrupt in the case of their bank collapsing, but most big established companies would have a diversified banking portfolio. So that's kind of drawing on what actually happens for consumers and for corporations. They're kind of similar, just slightly different on aspects of it. But what can the central bank do to actually help this? What can a central bank do to try to stop this collapse? So they see this collapse happening, and the central bank has to act. They have to try and do something about it, because you can't just leave a bank's collapse. So basically what they do is they try to provide a lot of liquidity support. Central banks may provide like emergency loans to banks that are experiencing financial difficulties, and to help them to meet the obligations that they're owed. So you may have seen this with the Silicon Valley Bank. They have been guaranteed by the federal government, and they're making sure that everyone has access to their money. And this had a knock-on effect where a lot of the regional banks in the US also started collapsing. So the US government had to try to bring a bit of faith back and stabilize that market, because you had stocks going down 70-80% overnight, that they had to halt trading, and just the whole faith in the regional bank system in America had gone down, and also leaked into the major bank sector as well, where their stocks were also plummeting. Another thing they may do is they'll start supervising a bank's activities to make sure they're managing their risks and their reserves, and they're completely compliant with the relevant regulations. So there'll be a lot more monitoring on on the banks to make sure these kind of things don't happen again, and they protect consumers, and they also protect corporations from these sort of things from happening. And they will implement a monetary policy. So central banks use like monetary policy tools such as interest rates and reserve requirements to manage the overall health of the banking system and try to prevent excessive risk taking. So this is something we may have seen in 2002 with the dot-com bubble. You're seeing it now when they had very, very cheap money for a long time. Risk appetite was more and more. You're seeing it in 2020, all these risky stocks, they went crazy. So that's kind of not good when they see large financial institutions taking risks. And that's what the SVIB bank did. They took a lot of risk onto startup companies, and they have a lot of exposure even into crypto and stuff as well. So that's a bit of a red flag, unfortunately. So they also look to provide deposit insurance, and this is what they've done for the regional banks and for the SVIB banks as well. So they've guaranteed all this for majority of people, so they all had access to their money over the weekend. And yeah, so look, it's a step that they have done in this case, and it's something that they can do for other banks that are running into these sort of issues. And then in extreme cases, they may provide financial support for failing banks. It's known as a bank bailout. There was a lot of this in 2008 across the European Union area, also across the United States, and it's being talked about at the moment that the US government may have to do this again. So bank bailout is the last resort, but it is also pretty common, and a lot of us have already seen it in our lifetime. So guys, a lot of talking there. My throat is a bit dry, but this is what happens when a bank collapses. The knock-on effects it has. What you can see is happening with the current bank collapse, and how it may have a knock-on effect to other people as well. So guys, if you enjoyed this, do hit the like button, hit the subscribe button. We do have a bit of an announcement in the next few days. It may have already been announced by the time the video comes out, but we are changing our money to Sam and Gino Talk Money. I think it's a bit more relevant because we're going to be focusing more on just talking about money and different aspects of money as well, instead of just focusing on the financial markets, just to have a more of a broad spectrum type of thing. So guys, thanks a lot, and I'll see you in the next one.